This is our Forex blog for August 11th, 2011, and today we release a new version which has, in my opinion, one of the best tools we've ever, in the history of our 8-year-old software company, ever come up with for trading. And I'm going to go over it in our regular class, but briefly show it in our Forex blog right now. Like most days, we look at the currency meter and we find, the yen has a very strong daily, weekly, monthly trend, and for most of the day it has strength, so you want to trade that against a currency that's weak. For example, the Swiss started off at 1 o'clock and it was consistently weak. Unfortunately, the Swiss's weekly and monthly trend are up, so you want to be careful there. The CAD has some real-time weakness here, and the longer-term trend confirms that. You can see there was a bit of strength followed by less strength and a little bit of weakness here that pretty much continued for a couple hours. The new tool we released is called FX Trend Pro, and it is absolutely one of the fastest tools we've ever come up with, but it also has the benefits similar to the IntelliTrend currency meter you see and you've seen in our past Forex blogs of when trends are strong, it pretty much gives a strong signal for multiple hours with very little whipsaws from green to red. The other one is far faster than this. It can oftentimes show you a new trend 5 to 25 minutes before this one. And because it uses 4 different statistical tools where we average them together, it keeps it keeps you into that trend. For example, the Swiss. You can see that the Swiss had some strength from 7 to 8 here. This one showed up a little bit later, and at 7:55 it went weak. This is using the new tool. One of the strongest currencies at that time, coming up to 8 o'clock, was the dollar. As you can see, it had daily, weekly, monthly trend that was up. It had brief amounts of 10 minutes here, 10 minutes here, 5 minutes here of weakness, but for the most part it was relatively strong, even right before 8 o'clock here. So the dollar Swiss was one of the better currencies to be looking for buys. And as you look at a regular chart here, coming up to 8 o'clock right here, that was one of the stronger currencies, and it took it a little while. About 20 minutes later it just absolutely took off. The currency meter gives you a really huge heads up of that trade. Just recently, right before class, we have some heavy strength coming into the New Zealand. It started at 10:30 and it pretty much has been strong since. So you want to buy the New Zealand versus one of the other currencies. You can see it really went green on that on the new tool here at 10:30. The older tool, it was 10:40. So it gave you a 10-minute head start on looking to get into this currency, and at 10:40, what was one of the weaker ones? The dollar was quite weak. Let's bring the dollar over again. At 10:40 you can see, in fact a little bit before that, the dollar started to get weak here at 10:20, and it was quite weak at 10:30 also. So looking at the New Zealand dollar chart at 10:30, you'd want to be looking to buy it. Strong New Zealand, weak dollar. You bring up a chart on here at 10:30. Here's the 10:30 bar right here. It was just underneath the hourly moving average, and it broke from underneath it to above it, so therefore you go long once it goes a pip above this bar's high right here at 81.70, and you can see it pretty much exploded up 70 pips. You had literally 10 minutes to bring up the chart, watch it, wait for a breakout to get into this trade. And even if you got out of it here and then bought the breakout again here, you caught 50 pips on that move, 20 pips on the first one. And you also have the benefit of using range bars. Range bars really give clear pictures, and they allow you to get into trades that you might be afraid to on a 5-minute or longer chart due to having a wider stop and higher risk. Let's say you put a 6 pip per bar range bar chart here in the New Zealand dollar. This has to download tick data. So 10:30 is when we're starting to look for this, right? And you can see it actually even had a a pullback at that 1030 bar. So you might have got into this trade a little bit early, or if you're conservative, wait for it to break out here. Or if you're, afraid of false breakouts, when it goes up, comes down, and breaks out again, you get in. Whatever way. And even if you add 10 pips to it and you got in it, or 6 pips to it and got in at 81.70, you can see that the currency meter really had this thing go up. And what if you missed the first move? Well, on a range bar chart, you can clearly see a nice pullback here, a little sideways action. When it breaks out here, you have a very tiny risk of less than 10 pips. You also have a profit target of a Fibonacci area from here to here. And, let's say you got out of this trade here and you didn't ride it up another 23 pips. Out at 22, if you bought this breakout right here in the mid 80s, you made about 38 pips. And what if you're really late to the party? The 1030 is when it gave the signal, and you didn't get in here, and you didn't get in on this pullback here. What if you got on this pullback here? With a range bar chart, if it's set correctly, a lot of times you'll have a 2 to 5 bar pullback. Remember, each of these bars is 6 pips. After 3 bars down and 1 bar closing up in the direction of the trend, you go long with your stop 1 to 3 pips underneath the low. And again, the last move up, you draw your fibs on it, and I didn't quite do that correctly. Let me move this up 2 pips here, and you can see it just hit this. Now it's already moved up 1 wave, 2 waves. This is the 3rd wave, and frequently, trends start to slow down after the 3rd wave up, unless they're super strong. This has already gone up over 100 pips from the low today, so it's likely to stall here. Let's say you went long at 20, you're out here at 40, you made 20 pips, and this is really getting to the party late in this example. Let's look at another one that showed incredible strength today. At 5:30 here, the pound went really strong. Now the only downside of this is the daily and weekly trend were down at the time. The monthly trend had shifted up. So even if you're afraid to buy it right there, and it was only strong for 10 minutes, and then it had 10 minutes of weakness. Whenever you see very little weakness after some intense strength, that strength's likely to resume. So I can see even the most conservative traders might at 555 start looking for buys in the pound. What was the weakest one at 555? Well, the Australian was quite weak at that time, and all the time frame trends for the most part. The daily just barely shifted up. It was quite weak at that time, even beforehand. So you could use the pound against the Australian. And let's just bring up a 5-minute chart. I don't normally trade this one. Pound Australian, 5:55 a.m. And again, you saw that the pound went strong earlier, and the Australian went weak earlier than 5:55. But even here at 5:55, if you bought this breakout, you can see it shot up about 20 pips, pulled back, went up, pulled back, went up, pulled back, went up. It went up a tremendous amount. You had, a long time to profit from it. Now let's look at this tool called the FX Trend Pro on the individual chart. A lot of times individual chart will flip before the currency meter does, because this uses all the pound pairs and all the Australian pairs. If the pound and the Australian are weak, but the pound is less weak than the weaker Australian, it's going to flip earlier. So let's bring this up, FX Trend Pro. And another one of our tools that we just released today is called the Fisher. I didn't actually install it in this directory here. Let me just bring up I always name stuff. So anyway, looking at this individual chart, you can see it actually flipped to the long side right here at 5:30. And if you bought the breakout of that, if it goes a pip above there, you're in this trade quite a bit early. And even if you got out during this sideways consolidation at 90, you have a nice, beautiful 60 pip there. Now this is another perfect example of why you want to use range bars. When you get into this trade with this very choppy 5-minute bar, it's very hard. So let's put on, this is a little bit more volatile, an 8 pip per bar chart. Alright, here we go, finally. Now remember, the pound was strong and the Australian was weak, coming up to 5:30. And look how clear it looks on an 8 pips per bar chart. Here's 5:30, you have this breakout here, you have your stop, a reasonable amount of pips underneath it. And when it went sideways right here and pulled back and went underneath here, you might have got out of that trade. And this is an example of what I meant by a 2 to 5 bar pullback. You have 2 bars down, 1 bar up, you go long, or you can just wait for this high to get broken out, and you can see it just, trended pretty much straight up. You would have got out somewhere in this choppy area right here. Let's just round down to 80, but you made 30 pips there. And you might have also went long right here. Again, after this pullback, sideways long enough, it broke out, didn't break the high. You had every opportunity to have a very small loss on here or out at the double top, whatever. And then here you have a breakout down, a pullback, and it went below that low, then immediately came back. So you go long with your stop underneath here, and this one just, it really took off, and you have your Fibonacci profit target level from the last wave as a guide to when to get out. And usually a good place to get out is, sometimes it shoots past the first fib target and it keeps going. First bar that goes red, put your stop pip underneath it, and you pretty much get out of the whole trade right here at 28. But you're in it around 80, out around 30. You made about 50 pips on that trade, and you had plenty of other opportunities to catch some pips too.